All right, let's dive right into this explainer and absolutely demystify the dense regulatory language of VAS 06. The goal here is so you can confidently classify and account for leases in Vietnam. Because honestly, whether you're drafting the contracts, managing the balance sheet, or just trying to figure out where your company's assets actually sit, understanding the standard is absolutely crucial.
Think about this for a second. If you rent a machine for 10 years, do you truly own it? Well, legally speaking, maybe not. But financially, that is a completely different story. This question perfectly sets up the entire philosophy of this accounting standard. It's really not about what the contract is called, but rather who actually holds the risks and the economic rewards of the asset.
Here's our roadmap for today. We'll start with the core lease concepts, compare finance and operating leases, look at the lessee's perspective, flip to the lessor's perspective, and wrap up with the sale and leaseback rules.
Section 1. The core lease concepts. Let's get our foundational vocabulary down. Okay, so the absolute crucial point here is that VAS 06 demands we look right past the word lease. The standard operates strictly on a principle called substance over form. Basically, we have to determine if the arrangement is secretly just a purchase in disguise. Because if the economic reality is that you hold the risks of the asset breaking down, but you also get the rewards of making a profit from it over its whole useful life, well, VAS 06 says you have to account for it as if you own it, totally regardless of the legal paperwork.
Next up, minimum lease payments. You know, when calculating the true cost of a lease, you really can't just glance at the monthly rent and call it a day. This calculation includes the total payments over the lease term, plus any guaranteed residual value. What you specifically leave out are contingent rents, like, say, extra payments based on your sales percentage, and any service or tax costs the lessor pays that you just reimburse. But if you guarantee the asset will be worth a certain amount at the end of the lease, yep, that goes right into the calculation.
Driving all of this is our next concept, the implicit interest rate. Every single lease essentially has a hidden, built-in loan rate that we must unpack. It's the exact discount rate that forces the present value of all those minimum lease payments, plus the unguaranteed residual value, to perfectly equal the fair market value of the asset today. It's basically the invisible financial engine driving the whole contract.
Moving on to Section 2, finance versus operating leases. Now, your accounting treatment hinges entirely on a strict dichotomy here. If substantially all the risks and economic rewards transfer to the user, boom, you have a finance lease. If they don't, it defaults back to an operating lease. It really is that binary.
So, you might be wondering, how do we actually know if the risks and rewards have transferred? Well, paragraph 09 of the standard gives us a highly specific checklist. 1. Does ownership transfer at the end? 2. Is there an option to buy the asset at a massive bargain? 3. Does the lease term cover the major part of the asset's economic life? 4. Does the present value of the minimum lease payments make up substantially all of the asset's fair value? And 5. Is the asset so specialized that only the lessee can use it without major modifications? Honestly, if you answer yes to any of these, you're almost certainly dealing with a finance lease.
But wait, what if the asset literally lasts forever? Note this fascinating edge case from paragraph 12. Because land has an indefinite economic life, the risks and rewards never truly transfer by the end of a typical lease term. Therefore, a lease of land is kept firmly in the operating lease category, and you just allocate the rent expense evenly over the lease period.
All right, Section 3, the lessee's perspective. Let's put ourselves in the renter's shoes. If you have an operating lease, your life is super easy. You just record your rent payments as an operating expense on a straight-line basis over the life of the lease. Done. But if you triggered one of those finance lease criteria, the whole game changes. You must now recognize the leased item as a physical asset on your balance sheet, right alongside a corresponding liability for the future payments. Plus, you now have to depreciate that asset over time, and you must split your lease payments into two parts, paying down the principal debt and paying a finance charge, which is basically interest expense. So a finance lease dramatically inflates both your assets and your liabilities. But what number do you actually put on the balance sheet for that finance lease? We can't just guess or pick a number to make things look good. VAS 06 gives us a very strict rule. You record it at the lower of the asset's fair value at the inception of the lease, or the present value of the minimum lease payments. This strict cap is absolutely crucial. It ensures lessees cannot artificially overstate their assets to look more robust to investors.
Section 4. The lessor's perspective. Time to cross the table.
For the owner of the asset, the accounting completely flips. For an operating lease, the lessor keeps the asset on their own balance sheet, depreciates it normally, and records the incoming rent as straight-line revenue. But if it's a finance lease, the standard recognizes that the lessor has effectively sold the asset. They literally remove the physical asset right off their books. Instead, they replace it with a financial receivable equal to their net investment in the lease. They're no longer a landlord, they are effectively a lender now.
And how exactly does a lender make money? Through interest, of course. This brings us to unearned finance revenue, which the standard defines as the difference between the gross investment, that's all the minimum payments plus any unguaranteed residual value, and the net investment. This difference right here is the lessor's future profit, which they will systematically recognize as finance income over the life of the lease, using a constant periodic rate of return.
Finally, Section 5, Sale and Leaseback Rules.
A sale and leaseback is exactly what it sounds like. Step 1, you sell your asset to a buyer. Step 2, you immediately lease that exact same asset back from the new owner. Now, why would anyone do this? Companies do this to free up trapped cash. Say you own an expensive factory. You sell it to get a massive influx of liquidity today, but you still get to keep operating inside the factory by paying rent. But beware, the accounting rules heavily restrict how and when you can recognize any profit from that initial sale.
Just like before, it all depends on the type of leaseback. If you sell the asset but immediately take back all the risks and rewards via a finance lease, VAS 06 essentially stops you from booking an immediate artificial profit. Any gain you made on the sale must be deferred and amortized over the lease term. The logic here is that you never really gave up the asset's economic benefits. However, if it's an operating leaseback, it's treated much more like a genuine sale, but with some very strict guardrails.
The rules for an operating leaseback are tight. If you sell the asset exactly at fair value, awesome, you recognize the gain or loss immediately. But if the sale price is artificially high, meaning greater than fair value, you absolutely cannot recognize that excess profit today. You must defer and amortize the excess over the period you expect to use the asset. VAS 06 ensures that any manipulation of the sale price versus the fair market value is forcefully corrected over time.
Whether you are the lessee or the lessor, the final requirement of VAS 06 is transparency. Paragraphs 38 through 41 mandate detailed disclosures. You have to openly declare your future lease commitments broken down by time periods, under 1 year, 1 to 5 years, and over 5 years. You also have to disclose contingent rents and any purchase options. This ensures that investors reading the financial statements aren't totally blindsided by hidden debts or future cash drains that are locked into these non-cancelable contracts.
I really hope this explainer helps you look past the paperwork and see the true financial mechanics at play. Whether you're dealing with implicit interest rates or categorizing an operating leaseback, just remember that accounting is ultimately about capturing reality. So, the very next time you look at a lease contract, ask yourself, what is the actual economic substance hiding behind the legal form? Keep questioning the substance and keep learning.